Hey, in today's market update, we are going to take a look at the stock market and a couple key trends you need to know about. And we're also going to look at the housing market. Mortgage rates have been going higher recently, and we're going to tell you what you need to know about that. Let's dive into it. Okay, so the day following the election, we had the biggest increase in the stock market ever for a day after the election. And the following week was pretty strong also. In the last few days, the market has pulled back some. There had started to be some signs of euphoria, but we wanted to put it into context by looking at some historical data that can help us as we're making decisions on how to manage portfolios in the months to come. We're going to start off by looking at the 3-month historical performance of the S&P 500. This goes back to 1950, and you will see that we are in the midst, November to January. The S&P 500 has averaged a gain of 4.4%. That is the best 3-month stretch in the calendar year. So that is very positive. This is typically very strong November, December, and we've seen that so far. Now, the next chart we're going to dive into takes a look at how the stock market is done following elections. And there's a lot on this chart. We're going to look and focus in the bottom right-hand corner, looking at the last 10 elections. On average, over the next year, the stock market has had a gain of 15.2%. And just as good as that is that 9 of the last 10 elections, the market has been higher a year later. So there's a lot of reasons for this. For example, a lot of presidents, once they win, they want to come out hot. They want to have popularity and get a lot of things passed in that first year. And so they're doing a lot of things that typically causes the stock market to go higher. So this is a good trend as we're looking at how do we want to position portfolios for 2025. Now, the next chart we're going to look at, this is a little unusual here, right? In that we have a president who already had a first term, but this isn't consecutive terms. So we wanted to go back and look from the date that Trump won in 2016 through the end of 2017, and you will see the S&P 500 was up almost 28% in that time frame. And I will note that the largest decline the stock market had in that period was 4.5%. In fact, 2017 was the least volatile year for the stock market in the last 30 years. There are a couple of reasons for that. The most important one was probably the tax cuts that were passed late in 2017. They were in the works throughout the year, and that cut the corporate tax rate from 35 to 21%. That made a big boost into corporate profitability in the years to come. I will also add here, when Biden won in 2020, from that point through the end of 2021, the stock market was up even more. So a lot of times it isn't only about, hey, who won, but it's about the uncertainty of the election is in the rearview mirror. The market likes that a lot. Now, we also wanted to go back and look at Trump from the day he won election through the end of 2019. And we're not counting 2020 because it was the COVID year, very strange. If we put that in, actually the markets were up for 2020, and so they went up even more. But we're looking at basically the first 3 years in kind of a normal climate. And what you'll see here, the S&P 500 was up 60%, and that's a gain of over 20% per year there. You had the tech part of the market, the NASDAQ, QQQ, up 86%, did very, very well. A couple other good performers, the financials, banks and other financials, up 63%. That was strong. The Russell 2000 small caps were up 45. Consumer staples, the VDC, were up 29%, significantly underperformed. We will be selling the VDC in our models for clients other than our capital preservation model, because they're just not as attractive in an environment where economic growth is expected to do very well, and that is expected in the years to come right now. The last thing that I wanted to show here, gold was only up 17.5%. And if you look, gold's in purple there, you will notice that for the first 2.5 years, it actually made no money. It was in the last 6 months of 2019 that it went up about 17%. So gold really struggled in this administration. Now listen, this is a different time and you're not going to have exacts from one term to another. So we're not going to replicate this exactly, but it is important to know that we do have a playbook. And for this term, we know that Trump is going to try to pass tax cuts, and we think that is going to happen since the Republicans got a sweep, and there's going to be cuts in regulations. Both of those two things happened in the first term, and so I think a lot of the trends that we saw last time, first time around, are going to be in place this time. So while the charts we just went over are very positive for the market outlook, we have to also keep our eyes alert for anything that could become problematic. One such area we talked about last time, the interest rate on a 10-year Treasury rate has gone up over the last couple months as future economic growth prospects have brightened. And this started even before the election. In September, the second half of September and October, rates started to go up. The 10-year Treasury rate right now is 4.4%. We don't want to see this above 5. That can be an issue for the markets. So we'll be watching that. But one impact that has is it means mortgage rates are going higher. On this chart, you will see that in the blue there, that is a 30-year mortgage, and that has gone from 6.1% about a month and a half ago to over 7%. And we've had some times over the last couple of years where rates have been over 7%. They peaked at north of 8% in October of 23. And by the way, that month was an absolute freeze in the housing market. There was nothing happening, no mortgage applications. It was really poor. Right now, though, 7% interest rates are cooling things. We just had housing starts come out, and you will see 1.3 million annualized on housing starts. And notice this is near the low of the kind of post-COVID period here, 1.3 million, very close to the low. So the bottom line is when mortgage rates are up near 7% or higher, there aren't nearly as many homes started, nearly as many people buying homes as there are when mortgage rates are down near the 6s. So we're going to keep an eye on that because we know the housing market's very important. We've talked a lot about this over the last couple of years. We look closely at the amount of employees in construction and the amount of construction spending in aggregate. Now, another chart that you probably have not seen anywhere else. This is taking a look at the distribution of mortgage rates for everyone outstanding. And what you will see here, the current rate is 7.1%. This is the percentage of the population here with mortgage rates at these different levels. And over on the far left, notice like the best number there is between 2.75 and 3%. Over 12% of the population have mortgage rates there. But what I want to pay attention to is if you take a look at 4% and under here, that's where the majority of the population have fixed rates. Listen, this is a very good positive, meaning even though interest rates have gone up a lot, the Fed rate hike cycle did that. We have noticed here that consumer spending has remained very strong, and it's because the jobs market has been very good, but it's also because a lot of consumers have locked in interest rates at 2%, 2.5%, 3%, 3.5%. And so that means their payment is much lower than it would be if they went out and got a new mortgage today. So the longer rates stay at 7% and higher, this will slowly go down where you have more and more people on the left-hand side with those lower rates. That will slowly change, but for right now, this is good news for consumer spending. Many consumers have locked in rates very low. Okay, so just to recap, we talked about the fact that the stock market is in the strongest 3-month period of the cycle, November through January. We also looked at the 1 year following the election and saw that over the last 10 elections, the market's average return of over 15%, 9 of the 10 times it's been higher 1 year later. We looked at the first Trump presidential term, at what did the best in the markets, and while history doesn't repeat, it often rhymes. That could happen again this time. On the housing side, we looked at the fact that mortgage rates have gone from 6.1% to 7.1% in the last couple months. That has had a chilling effect on housing starts, people buying homes with rates higher. But we talked about the fact that when you looked at the distribution of rates across the country, most Americans have interest rates on their mortgage of 2 or 3%, and that has powered consumer spending over the last couple of years. Thanks a lot for watching the video, and take care. Okay, so if you are new to Sentara Capital, if you have not seen any of our videos before, you can head over to sentaracapital.com, check out our website. You can go to the contact page and reach out to us, have a phone conversation. We have a 3-meeting process to see if we are a good fit for each other. And if you are not getting these kind of market updates from your advisor, we would love to talk to you. Thanks for watching, and take care.